We have Craig Birchall, who's the head of credit trading at FalconX, joining us. We have Ami Ben David, CEO and founder of Ownera. We have Robert Krugman, who's the chief digital officer at Broadridge. And moderating this panel will be Steven Sandberg, who is the head of Fund Connect, digital product at State Street. So welcome on. Appreciate you all closing us out.
Hi, everybody. I'm Steve from State Street. We're going to be talking about Collateral. And I think, as we all know, there's a lot of work and a lot of investment going into bringing real-world assets on-chain. Collateral is one of, I think, the initial use cases, something that's been identified as having a lot of value for institutional especially. And so we're going to talk a little bit about what that means and how we see that playing out. So maybe let's start off with introductions. You guys just want to talk a little bit about yourself and what you're doing in the collateral space?
Sure. So I'm Rob Krugman. I am Broadridge's Chief Digital Officer, so I lead our digital strategy and innovation practices. When it comes to collateral, specifically in the digital asset space, we've gotten quite a bit of press around some work we've done in the repo space, where today we are tokenizing about $370 billion worth of repo on a daily basis, and then amounts to about $9 to $10 trillion a month that we're actually running through our pipes.
Hi, my name is Ami. I'm the founder and CEO of Ownera. We also operate in the collateral space. We have two main projects. One is open intraday repo. We work with JP Morgan and HQLX and others on intraday repo, and now expanding it to multiple venues. And then we have the open collateral project as well, where we help institutions use tokenized money market fund as collateral for derivative trading.
And I'm Craig Birchall. I'm the head of lending at FalconX, and I have a bit of a different angle on the market, in the sense of having been in the crypto lending space for about 5 years now and seeing how the industry is actually developing and coming from the convergence in a different direction, which is really exciting.
Thanks. So let's start off just a little bit of background. So maybe talk about what are repos, how big is that market, and how much of that is tokenized today? So Rob, you mentioned you have several hundred billion tokenized today. Yeah?
On a daily basis, I think I was looking up numbers earlier today. Does 12 trillion sound correct? Yep. I think, right? It's on a global basis,
US
I think.
basis, actually.
Yeah, US-based repo is about a $12 trillion market. So we're doing about, I think it's about 365 billion a day. So I know you guys are also working on different things. So we're starting to see tokenization enter the space, really driven by the efficiencies that can be delivered to market participants. A lot of it's intraday. I think there's going to be growth on overnight repo and other activities as well, as we start to see more and more assets not just be tokenized, but I also believe as more and more infrastructure starts to make its way through the capital markets ecosystem to support it.
And let me ask, at Broadridge, what is your role in these repo transactions?
So we're essentially providing an underlying platform to facilitate the activity among the banks that we work with. So, in some cases it's interbank, in some cases it's external to multiple banks that are actually participating, but we have clients that are signed up to use our platform to facilitate this activity. We're running on the Canton network today, and we are essentially immobilizing US treasuries on behalf of our clients, and then we're facilitating a repo transaction and creating the smart contract, which represents the actual deal specifics.
Yeah, thank you. Ami or Craig, anything to add?
Yeah, on our side, when we are dealing with intraday repo, it's slightly different. Today, intraday repo can be done on there are two legs basically, and there's two sides to the trade. There's the collateral and then the cash. Having one side tokenized on one chain is one thing. Needing the cash collateralized is another thing. Our kind of platform connects the various parties in the market, where you can have the collateral anywhere on any blockchain, and you can have the cash anywhere on any blockchain, even on fiat. And you can have the trading platform be any trading platform, even connected through FIX. So we're trying to create an open environment that is multi-chain, multi-partner, multi-collateral, multi-everything. And that's basically where we see the market growing, because $12 trillion will not sit on one platform, it will be open. So I think the openness is definitely the key there. We started working with JP Morgan. They were one of the first players in the market doing intraday repo in that fashion, and we kind of helped them expand between chains. In their case, it was Kinexys on one side and Corda on HQLX on another, and then we're growing from there.
Yeah, and I think coming from the side of the more digital asset native lending, and I'd been at Galaxy when they had first stood up their lending desk, and then down to today at FalconX, and it's interesting because that market is actually fundamentally structured differently under master lending agreements that are closer to being similar to like a master securities lending agreement, but over time, the world has kind of converged. Crypto lending is a very interesting combination of like securities lending, margin lending, and repo all kind of thrown into a mix. And what I've found is recently, the interest in repo, even from more of the digital asset native side, has increased, especially as traditional financial players, banks, et cetera, are starting to dip their toes in the market. There's a lot of benefits, obviously, to repo. There's bankruptcy remoteness. There's capital benefits to a lot of the firms. And so, it's interesting to see actually parallel agreements that sometimes are saying the exact same thing, except one is under a repo and one is under a bilateral MLA. And having kind of firms decide how to structure it, especially is like intraday liquidity in repo is like almost borderline non-existent among the firms in the wholesale market as they exist today, which is a pain for quite literally everybody and my team back at the office right now. And so I think that that's something that it's interesting to see evolve, and I'm sure we'll discuss like how that's also impacting the on-chain community, RWAs, and private credit. But I'm kind of like witnessing it again from the other angle, moving towards that direction as the industry kind of advances and grows up.
Now, what is it that you think makes collateral such a good use case, especially initially, right? So I think longer term, there's vaults, there's all sorts of things that we can do with digital assets. But I think as far as what I've heard, at least in the near term, collateral seems to be, kind of the thing with most traction or most tangible. Why do you think that is? And, what are the problems that it's really solving in the repo space?
I mean, I could start. I think that, it introduces significant efficiencies into the process. And to the point you were just making, we think about repo, and I think most people almost always go to US Treasuries as being the underlying basis for that. One of the things that, though we do have equity repo today and we have other products available, I think when we move to the tokenized ecosystem and we can use tokenized products as collateral for these solutions, it opens up a host of new opportunities where there's going to be significantly more liquidity available to kind of create these products on top of. And so, we're at the beginning. Right? So the reason that repo, I think, is kind of such a big driver right now is it's treasuries and kind of an easy one to get your head around. I think as we see tokenized equities and tokenized private and alternative products start to come online and other types of products, we're going to see a suite of new repo and new solutions basically to leverage these products as collateral in a much more efficient way than maybe we do today.
I think repo is basically a very, very simple way of doing lending and borrowing, right? It's a simple way of now, the fact it's been used for $12.5 trillion a day in US markets alone means that it's an effective tool. But until now, it was also an inefficient tool and very hard to settle tool, which means that you only settle overnight. And that is why I think this was one of the first use cases of tokenization. I started tokenization myself, thinking that we tokenize VC fund and so on, and that's great, but there's still a long way there. But on repo, the logic is just simple. Today in repo, if you want to borrow for 5 minutes, you pay overnight, so you pay for a day. If you want to borrow for an hour, you pay for a day. If you want to borrow for 3 hours, you still pay for a day, right? With intraday repo, tokenized, you can precise your lending by the minute. So if you want to borrow for 5 minutes, you pay for 5 minutes. It's a no-brainer. Why not? Now, if we can make it tokenized, it means that the whole workload around settlement and the back end and it just disappears. So it's a simple lending mechanism that works by the minute. Why use it only between banks? Why not use intraday repo more with with hedge funds, with asset managers, with treasuries? And then, the sky's the limit because everybody wants to lend and borrow against their assets. So I think that what we're seeing is really just the beginning, and that's the feedback we're getting from across the market.
Yeah, and I also think like an interesting thing, a dynamic that we've seen, I mean, the definition, depending on who you talk to, of what qualifies as a stable coin or not, but whether it's yield bearing, whether it's not, whether it's Genius Act compliant, or it is, but like sort of in sort of that general bucket of assets that are attempting to peg themselves at the US dollar, I would say, there's a lot of interest in stablecoin repo itself. I mean, it would help us out a lot too. Between the mint fees, the burn fees, the fact that a lot of these issuers also a lot of times are tracking whether or not you've gone and burnt the different assets, and it starts to become there's a significant use case there that I think every primary dealer, including the exchanges, would have if we can get onto a proper mechanism, which I think that we'll talk about. But like, you know, something like being able to actually programmatically govern the repurchase contracts, for instance, is an interesting way. Because right now there really isn't an efficient or robust lending market that actually is just swapping stable coins on a temporary basis.
Yeah, I think also for repos, maybe, you know, some of the hurdles are a little lower. So I think the regulatory hurdles, right, to doing tokenized repos or tokenized collateral repos is lower. The workflows are simple, and as you mentioned, you know, the size of the market is huge. So there's a lot of benefit for customers there.
It's also, I think it's primary institutional, and I think that's a big reason why it's easier to get started. You know, when it comes, if you think about like institutional use cases versus retail use cases, as soon as you start moving towards retail use cases, there's a host of issues that start to present themselves, whether it's, you know, governance or disclosure or other activities where you want to protect investors. You know, when it comes to institutional use cases, there's an expectation, I think rightfully so, that the people participating in the market know what they're doing. And so that does make it easier to get things through the, you know, through the process and get people more comfortable that this is a good starting place. Yeah.
And I'd actually be curious, like for both of you, like, are you seeing more? I know we've like touched on it a bit. We were talking yesterday. Like, where do you guys see the evolution of the centrally cleared market versus bilateral? Like what is the majority of the activity that you're seeing today, and where do you see that going?
I think bilateral is mostly for, you know, one asset, where in the party you can do baskets and so on. But we're seeing also baskets being created now in tokenized form, and the work that we're doing, and we've demonstrated as well with the DTCC's app chain collateral system, that platform is enabling you to create a basket on the fly. So effectively, you can do what you could do with a tri-party on this solution, and a tri-party could use it as a tool as well. So I think that, you know, who you want to get your service from and to get the liability and so on is question number one. Technically, how to do it is question number two. The second question is resolved. You can do technically anything you want in any format. So I think that the market will still remain, you know, tri-party and bilateral, but I'd say the borders between them will be more along commercial lines than technology lines.
I also think, just building off what you said, I think the U.S. market may operate differently than some of the global markets as well, because as we're seeing, like as we see, you know, central bank digital currencies globally in certain areas, like the backing of these assets, you mentioned stablecoins, it's going to evolve. I think we're going to have to just, you know, pay attention and see where things head, because the regulatory framework is not nearly defined yet, and different markets are taking different routes.
Now, you touched on it a little bit before. So I'm familiar with repos really more from like a corporate bond repo, right? I think you mentioned equity repos. Craig, are you seeing other types, or do you think that there will be other underliers that come about in the future?
Yeah. Yeah, I mean, like coming from, like I've done Bitcoin-backed repos in the industry, which again is probably more akin to like an equity repo. I think what we're seeing now, I mean, probably the most significant demand that we see in the market is taking otherwise illiquid assets, primarily tokenized private credit, and allowing for that as repo collateral. Because there's a significant, like there's a really interesting dynamic where a lot of the on-chain money that's out there, outside of kind of the institutional ecosystem or a part of it, is for one reason or another, whether it's a leverage strategy that they're running or they're an asset manager that just runs a daily liquidity product, there's a need for some sort of daily liquidity. Now, we run a pretty large tokenized private credit RWA. And we have a 30 to 60 day lockup, which is a nightmare for me. Like folks that come in and recall and it's just 30 days. You know, and you don't necessarily want to interfere obviously with how the asset manager themselves needs to run their strategy. But that's not going to attract a ton of the on-chain capital that's basically begging for daily liquidity, and anything that's worse than that is severe. So there's a very robust, there's a lot of projects out there. There's a lot of folks that are raising money and creating secondary facilities and things like that, quite literally just to offer a solution to that in the form of a repo right now.
We were actually talking about this yesterday as we were talking about, you know, if you think about like private credit, one of the interesting components here is that if the underlying assets that are kind of making up that offering are tokenized as well, there's a lot more transparency into the underlying asset itself. And as things are being repaid and you can get more detail. So data is going to be a big opportunity here because the more data, the more comfort there is, the less risk there is, kind of works really well as a collateral instrument. Yeah.
I think to an extent, it's like once you tokenize something, you can repo it, right? So there's like tokenization just opens up a repo market to all these assets that are very difficult to do that today. Now, as far as posting collateral, I think what I've heard the most of, what we've all heard the most of, is tokenized money market funds. Why is that such a good fit for for collateral in particular, and what other kind of assets do you think would be coming along down the road?
The big use case we're working with on tokenized money market funds is for using tokenized money market funds as collateral for derivatives trading, futures and other derivatives trading. Because if you look at the market today, 70% of collateral is cash. Cash doesn't get the yield that you want. It's not really the best collateral in many cases. So people want to move to securities and other products. Tokenized money market fund is perfect for that. It's low risk. It's instantly, you can redeem it to cash instantly in some cases, or close to instantly as well. So it's a very, very high quality asset, and you get the yield, the top yield. Now, if you can use that in tokenized manner, then you have yourself a good use case. Now, once the CFTC in December last year basically approved the use of tokenized assets as collateral, within a month, I remember the day, it was 15th of January, we had a group with ISDA and something like 100 banks and financial institutions talking specifically about how to use tokenized money market fund as collateral. We didn't have to sell it. It sold itself pretty much. The whole market wants to do this. And now we're in a process where we've already done 2 simulations, and the third one is on Thursday, with dozens of banks that are actually connecting and using money market fund as collateral for derivative trading. You need to connect the pledgers, the receivers. You need to connect the tokenized money market funds, the margin calculation engines, which we've connected, the data provider, which we've connected. So we've connected all of them together, and we demonstrated the IAMs, VMs, and interestingly, where available, where possible, like VM in the US or in Europe on all collateral activity. Once the receiving part receives it, they want to rehypothecate. And guess how they rehypothecate? They use Repo. So we demonstrate how you can connect those 2 use cases together to use the money market fund as Repo to generate additional yield. So it all comes together, and it's all come together now. And a lot of it has to do with the change in the posture of the American regulators that literally opened the door for tokenized money market fund to be used in this way. Now, there are many providers of tokenized money market funds out there that were looking for utility for the product beyond just buy and hold. But now, if you can use this collateral for derivative tradings, it becomes something that people want to get in and out in a big way. And we have some in the audience here, some big players in the space, like Franklin Templeton and Wisdom Tree, and BlackRock are in the space, Fidelity, UBS, and there's quite a few players that are in the space looking at it because of collateral use cases that are interesting.
And both cases, collateral and cash leg as well, right? Because we're also seeing people have an interest in using money markets as the cash leg. So,
yes,
yeah.
But it's a bit more complex.
It is. It is interesting though, because I think this kind of speaks to what tokenization does, right? if an asset is liquid, in theory, it could be used, right?
Yeah, I mean,
that's a big change. Yeah.
I was talking about this project with, so the project has two legs, two parts. One is the part of the simulation that we're doing with actually connecting everybody and going to production soon with this. The other part is a working group led by ISDA, which is basically bringing in every week or every other week, I was on some of those calls, dozens of lawyers to sit down and build the book, which will be published hopefully by end of July. And that book will dictate to everybody, what does it mean, what is a tokenized money market fund? Because there are different types of them. What is the, the quality of each one of them? Can they be used? Can they not be used? And so on. So the legal and regulatory side is a lot of work as well.
It always starts with dozens of lawyers.
Yeah. I have to say that these specific meetings are, as you can expect with a lot of lawyers on the table, around the table, there's a lot of questions, but really the atmosphere is super positive. Like they're saying, we want to do this, we want to get it done, let's answer all the questions and let's just move forward with it. And I think that, the work that the CFTC did so far was very, very, positive for the market. So it's worth mentioning.
The only other thing I would note is, like, if we think about repo in the sense of both yield, as you mentioned, as well as generating liquidity, one thing that's been interesting is there's a dynamic essentially with a lot of the ETF providers where they're racing to have the highest yielding solution in some cases when the assets are actually stakeable within their mandate. And so, because a lot of the mandates are just staking oftentimes, like they're not going to, usually you can't go and lend it out or do a covered call strategy or something like that, obviously. And among the digital asset treasury companies as well. And so you'll run into a situation, though, where if they will go and they will want to maximize out to, effectively be staking 100% of the assets, well, what do you do when you have to go and handle a redemption? And so that's actually a decent amount of the liquidity, or a decent amount of the other interest that we've been seeing is, and sometimes it's like for like, whether it's a liquid staking token or the staked asset that's unbonding in tri-party, but a temporary repo just for that period. And we've seen quite a few of those actually recently.
I think what we've seen at State Street, our view is that for sure, and maybe it's obvious, by using it for collateral, obviously the uptake of tokenized money market funds is going to be tremendous, and it probably will add a lot more versus what we see in money market fund allocations today, which is purely yield-based, right? So now if you're adding utility to that in addition to the yield, I mean, it should be a huge multiple because it'll be used by people that are not using it today. Right?
What's interesting is that I think that point, I'm sure others get this question. People often ask, what's the benefit of a tokenized instrument versus a traditional instrument, specifically in traditional finance? You just hit on it. That's the answer, right? It's that you can use it for different things where it actually has utility, where you can not just generate yield, but you can leverage it in new ways that allow for monetization that maybe we haven't been able to do in the past.
It's also very valuable for the traders, especially around collateral use cases, to be able to all the time see their exact position at any point in time without having to pick up the phone and say, did it arrive, did it land yet, and so on. They just look at the screen, it's there or it's not there. It's like very immediate, and that allows them to plan better, to look for the better yield, and they love it.
And even to have to implement and utilize a different workflow, a different asset for everything that you do, and now be able to at least align that and use tokenized money market funds for a variety of purposes, I think is a big benefit. Makes it simple. You touched a little bit about OTC derivatives, right? And so I think for collateral, the use cases I think I'm aware of are we have repo, we have OTC derivatives, we have exchange traded derivatives, right? Are there any other kind of collateral use cases for for tokenized money market funds or otherwise?
Well, I'm going to go into a completely different area. You want to go first, then I'll try to jump into kind of the retail market. Yeah.
So I think that the tokenized money market funds are a starting point, and in the same way, treasuries as a backup for repo is a starting point. That's what people are used to and are accepting first. But it's going to go everywhere. Everything can be collateral based on the qualities of the asset. So you start with a tokenized money market fund in the UK now. Archax launched Govi, their product that gives you treasuries directly, and there will be other products that will be relevant, and then securities and bonds and everything else that can be used as collateral will be in there as well. Now you say to yourself, okay, so why stop there? So we've launched 2 weeks ago with Goldman Sachs and Apex Group and Archax a new real estate tokenized model. Now, how good is real estate as a collateral? It's pretty stable, right? It changes like on a yearly basis or quarterly basis rather than anything else. It's the largest asset class in the world. And today, it's not really being used as collateral in any efficient way. I mean, if you want to collateralize a building, it's bespoke, right? So I think it will go everywhere. It will pretty much flatten the market, and just every market based on the qualification or qualities of the specific assets will have different use cases, but a token is a token.
And I mean, I think we experienced it where most of the growth that came out of our structured credit facility that, I'll be honest, like when I joined, we thought the tokenization would be an interesting proof of concept or something like that. We almost realized by accident, by demand of the actual investors and lenders into the facility themselves, that they had gone and approached kind of the rest of the on-chain ecosystem that, we'll take a look at really anything that's tokenized. And, there's folks out there, there's curators, there's asset managers that will figure out the right amount, like the right LTV, understand the underlying legal framework of the asset, the reporting transparency, so on and so forth, and will lend against it. And what we found is like almost overnight, once the liquidity providers and things for liquidations and whatnot were created, like there's literally just an ecosystem that has nothing to do with us for just lending against our structured credit facility asset. And the vast majority of those funds are just coming back to us as folks are taking levered positions, which is really interesting, from a private credit concept. And it's great for us because we're able to we don't have to offer massive yields and attract sort of, for some of the mercenary capital that may be out there on chain, it could be 7% or 6%, but because of the leverage that they can get by the tokenized collateral, they may be getting 10 or 11% against it. So it's become really interesting as a way for us to raise capital within that facility as well as lower the yields, candidly.
I would say the other area that we're beginning to see is even on the retail side. So what we're beginning to see is firms thinking about use cases where they could leverage, client assets as collateral for lending pools, right? So it could be for mortgages, it could be for HELOCs, it could be for other types of products. But it provides a mechanism to not just potentially provide additional yield back to the retail customer, but to allow, as an institution, to create new monetization models on top of this that they may not actually be unlocking today. And that could be very interesting as we move forward. It could change the monetization and the fee dynamic quite significantly on the retail side of things.
There's also the other thing I would just add is like you're seeing a lot of tokenized gold now being used as collateral, and on the general use cases you see a lot of like folks that are going short or something, and they may be borrowing physical tokens that are going to be posting money market funds and want to be able to generate the yield. So from having joined the industry a couple of years ago, in the last year, a lot of this has changed in the industry. Like it's accelerating.
Tokenized mining is a fascinating one, right? Because tokenized gold, I was talking to a firm the other day that's doing that, and I asked her, you're tokenizing the real estate or are you actually tokenizing the asset inside? I said, yeah, just the asset inside, and we know how much is there. You can show proof of reserve, then you can really do anything with it.
I think in some respects it makes things like, I think you mentioned yesterday, a looping strategy much easier, right? When you have the digital asset. So, you go and buy the asset, you repo it, you take cash out, you go and buy another asset, you repo it, you take cash out. So you're kind of multiplying that yield. Is that something that you're seeing a lot today?
Yeah, definitely. I mean, it's like a massive part of the on-chain, like the DeFi ecosystem, is around the looping, and whether it's permissioned or non-permissioned, kind of gets into a bit of what we had mentioned earlier on the daily liquidity. But we've had folks approach us and say, okay, well, what's the next facility you guys are going to go do? Like, we're excited to get in it. Can we, like, folks have come in and tried to, like, what I've learned as a lesson is have all of that infrastructure set up as much as you can. Like, try to figure out who are the curators that are going to be willing to lend against the, basically be the counterparty on the repos, so that on day one, if someone comes in and invests in the facility, they have access to those looping strategies. And because of that, that also creates all sorts of like mandates open up for these folks. Like there's a lot of vault curators that are out there that are, you know, basically saying, okay, like come into my yield strategy that does X, Y, and Z. And almost all of them require either a looping strategy to be able to get the returns that they need or some kind of daily liquidity really that's effectively done in repo. So, you know, it's the difference between scaling from, I think we have like 150 million today in our facility between like folks have said, if you open these lines up and you can create a robust looping ecosystem for us that's liquid enough, we'll put in hundreds of millions on day one. And that's fairly common, but you need this infrastructure first.
Rob, the tokenized repo activity that you guys are seeing today, is it really mostly banks or is it all banks? And how do you see that kind of evolving and extending to other?
Yeah, it is. I think we're starting to see a lot of interest among the asset management community as well. And so we're kind of opening that up and expanding that. We've grown, our volume has grown 220% in the last year. So there's been massive adoption and interest, and we are continually adding more banks. But again, increasingly, it's the asset management community that's asking about this and wants to participate as well. Yeah.
Now, if you're a buy-side firm, asset manager otherwise, and you want to start doing it, how do you even go about that?
Yeah, you give us a call. You know, it's really working through the different infrastructure components that are required. We try to make it easy. You know, initially, you know, as we were thinking about this, it wasn't, you know, it's based upon traditional treasuries. So we're mobilizing the traditional treasuries. We're creating a smart contract on top of that. A lot of the settlement initially happening off-chain. Now as we start to move things on-chain and we have tools that we can use like stablecoins and other forms of digital cash, it actually provides even more efficiencies as this moves forward. But it's not hard to get started. Yeah.
We started with the settlement on-chain, and now we're moving to doing some of the settlement off-chain. Yes. I mean, there's room for all of these, and I think, you know, in relation to what you said, there's a very big difference between the traditional repo markets and what you see in digital asset markets. In digital asset market, everybody's, you know, looking for the most, you know, the loops and the models that will give them the most yield. But if you try to do that between two big banks, you're going to create systemic risks that could, you know, kill you know, economies. Yeah. So I think it's very different between what a TradFi environment would want to do with a 12.5 trillion market and do it like safely, whereas and therefore this is the reason why it takes longer for banks to get online and so on, because they have a lot of responsibility. Whereas on the digital asset space, right, everybody's running towards where they can make the most yield, and that's why it's such an exciting environment for some people.
You guys are showing what's possible, though.
Yeah.
Well, and it's interesting because now having seen the collapse of like 2 different systemic risks over the past couple of years in the industry, or when Kelp DAO was hacked, you know, and Aave went down, well, there's another systemic risk. Systemic risk happens like every couple of weeks in our industry, but it's an industry, it's an interesting thing though to see play out because honestly, yeah, like the instant liquidity has been a reaction. It's funny, I also started my career in traditional finance, so watching the on-chain ecosystem will come up with terms for things that already exist, you know, whether it's vaults or looping or whatever it might be, risk curation.
Farming.
You know, yeah, farming, right.
We have a glossary that basically we can give to the traditional folks to say this is what this means. Yeah,
yeah, and the industry then slowly realizes like, oh, off-exchange settlement would be an incredible thing, and you're like, you mean like literally how it works? But there are like interesting things that I think like unlock, and I do think like where I see these things the most converging right now, outside of tokenized securities and things like that and tokenized commodities, is probably in the private credit market. Because I see like there's a lot of folks, well, traditional asset managers would love the ability to access just an additional source of capital that can come out there, international asset managers, whatever it might be that like the tokenized aspect. And you have like folks in the on-chain community, I think, that are also just as interested. And you have a lot of like with the Sky ecosystems, one of their sub-DAOs or primes or whatever they call it nowadays, is Grove, and they invest only in traditional structured credit in a tokenized form, which is interesting because you have Sky, which is essentially trying to create like a decentralized on-chain bank, and then they have one of like the equivalent of a pod or a desk whose entire goal is to invest in these traditional structures. Well, that helps a lot of people and also creates kind of like an interesting convergence of what used to be the purely on-chain mercenary kind of ecosystem with some of the more traditional financial mindset. But you know, there's a middle ground, I think, between the two from an efficiency perspective.
Yeah, it's like, you know, I visit the banks, you know, day in, day out, and I think that what you just described and the different things, probably the DeFi market is at level 100 and the banks are at level 1. And then you're talking about risk, the banks are at level 100 and the DeFi people are at level 1, and you have to, you know, choose your poison, basically.
Yeah. That's why it's going to be hybrid for at least a little while. Probably a long while.
All right, well, thank you guys. Really appreciate your time here. Thanks, everybody.
Thank you. Thank you very much.
Yeah.
Thanks.